I am the owner and CEO of California Wealth Advisors. I also have a radio show. I know many of you found me through the radio show, KNX 1070. So thank you for joining us with that. That plays on the weekends, but all of my radio shows are on my website, California Wealth Advisors. You can always go there and click on the radio tab, and 3+ years of radio shows are on there. I also wrote a book, The Great Retirement Mystery, How to Avoid the 6 Biggest Blunders. The 6 biggest blunders are for anyone. You don't have to be in retirement for that. But a lot of good information in my book, in my view anyway. I had a ghostwriter that really talked to me about what I do and how I do it, and he really captured me, I think. So go ahead and get that. Barnes & Noble, Amazon is places to go get that. Okay, let me talk about a little bit of what we do and how we do it here at California Wealth Advisors. One of them is, I'm going to stop sharing the screen here for a minute. I'm going to draw on my little board here. So when we have clients that need full financial house services, they really need an overall financial view of their house, not just perhaps their investment dollars, which Joanne is certainly going to talk about tonight. But I position myself here as the financial director in my clients' portfolios. So I am like the quarterback, if you will. And of course, we have your investment dollars in your financial house. Again, we're going to talk about that in depth tonight. But you also have other areas of your financial house that are incredibly important as an overall financial view of your entire financial house, your entire portfolios, if you will. So one of the first things we look at is risk. What is your risk tolerance over here? What is your risk management that you have in your entire financial house? And what am I talking about here? I'm talking about taxes. What kind of taxes are you paying? Are you paying too much in taxes? Let's look at that. Let's take that off the table as far as risk, though, because that to me is a risk. When you're paying too much in taxes, you're not putting more dollars in your pocket. We also look at in all your insurances, perhaps your umbrella policies, for instance. If you have a lot of rental properties, how your umbrella policies might be affecting you. We look at Orlean at titling here, titling of your assets. That's a huge risk for a lot of people. If you have a lot of real estate, or if you have a business that's titled in your names or you're in your spouse's name, you can actually be sued for the asset of all of your assets, actually, not just that asset, if it's not titled correctly. So let's not open ourselves up to lawsuits there. And that's, of course, a risk too. So there's a lot of other things we look at here, but risk is certainly one of them in your overall financial house. So let's make sure that's taken care of for you. Then we're going to look next at estate planning. Ooh, I spelled that wrong. Estate planning. Oh, can't write here. Estate. There we go. Estate planning. So again, we're going to look at your estate planning documents. Are they correct? Are they current? Because a lot of times people come to me and their estate planning documents are 20 years old. And a lot of times tax laws change. Where you want your assets to go changes. Maybe you have grandchildren now, you'd like to inherit some things. Let's make sure your assets, again, are titled correctly and they're going to the heirs and beneficiaries you want them to. So estate planning, of course, is huge in what we do there as well. This over here, this last section I'm going to talk about here is the vault, or the family office, we call it. So that's where all of your important documents go. So your passports, I have many clients that travel. Your passports go in there. We do a once-a-year balance sheet for you that puts all of your assets, whether I manage them or not, on a balance sheet. Your estate planning documents go there too. So again, your heirs will know to come to us if something should happen to you, because we'll have the medical power of attorney, the medical directives that might be needed if you're in that kind of a situation. If you pass away, your heirs will know to come to us because we have all those documents as well. So the vault tends to be a really good place for a lot of folks to keep their documents. You'd absolutely have access to it as well. Then we go to the investment dollars. So again, we're going to talk about that tonight. I'm going to talk about a little bit more when I bring up another slide, but your investment dollars are certainly very important. It doesn't matter if you've got $1 million or $100 million over here. If you're not taking care of all of these other things, if you can be sued, or you can lose your assets, or all your assets are going to go through probate, or you don't have a good place to keep your documents, all of these things affect all of you and your estate planning and your overall financial house. So if your dollars are important, and again, Joanne's going to talk about that in a minute, how we manage a lot of those assets, but we also manage them in other ways. So let me go back to sharing my screen. Okay, so again, this is a more detailed drawing, if you will, of what I just drew for you there. But also, when we create portfolios for folks, we want to have a plan. And those of you that listen to me on the radio show, I talk about this all the time. You need to have a plan for your assets. You also need to have diversification of your assets. Don't have all your eggs in one basket. Many clients come to me and they have $1 million, $2 million, $10 million, $100 million in a big wirehouse, for instance, that's all stocks, bonds, and mutual funds. And that is, in my view, not the best place to put all of your money. Some of your money, certainly, and Joanne's going to talk about what we do there when you have managed money. But to have diversification, to have a plan, and to have it professionally managed, in my view, is the best way to go. So I created this master proprietary process years ago to help people understand how assets work, where assets are, where your assets might be. So again, a lot of people come to me and they're in the red section, stocks, bonds, and mutual funds. That's something that Joanne's going to specialize in speaking about tonight, which is great. I love that section. It's wonderful. It's red for a reason, though. It is going to go up and down. So a lot of times we'll look at the alternative space. We'll look at real estate. We'll look at private placements, the oil and gas programs. We have 1031 exchanges. We do opportunity zones to help avoid taxes when you sell a highly appreciated asset, perhaps like a business. I have a lot of clients that sell their businesses and they want to avoid those taxes. We look at the alternative space there. And then if you really want to have safe money or income generated for your life, we look down here at annuities, life insurance, CDs, cash, any kind of safe havens for money. A lot of people get scared with markets. Joanne's going to cover a lot of that tonight. So make sure that when you are looking at your overall financial house, you actually have diversification and you actually have a plan in place for yourself. Okay, let me introduce Joanne. So Joanne, I will send you the slides in a minute here, Joanne, but I want to introduce you. So Joanne is a partner at Advisors Capital Management, who is one of my favorite money managers. She has served as portfolio manager of the Growth and Balance strategy since 2015. Joanne took a circuitous route to becoming a portfolio manager, having started her career as an economist on the facilities of the University of Colorado at Boulder, the Stern School of Business at NYU, and at the State University of New York at Albany. She also consulted for the Federal Reserve, the International Monetary Fund, and the World Bank. She then took her economics training to the technology investing worlds, helping to build a semiconductor R&D and manufacturing operation in upstate New York, and then becoming a semiconductor analyst on Wall Street at a number of boutique investment banks. She's also a very dear friend of mine, and you can see her regularly on MSNBC, CNN, Fox Business, lots of different places. So with that, I will give the slides over to you, Joanne. Thank you again for joining us. We are very privileged and honored to have you here, and you take it away.
Great. Thanks, Kelly. Thanks for that introduction, and great to see you again. Always a pleasure. I wish, we were back in, I think, 2019 when 2018, we got together to do this in person. You always had a nice little location for it and a good crowd of folks. So those of you out there that I met back then, nice to see you again, sort of. Yeah. But always fun to talk to your crowd, and I'm looking forward to your questions. So yeah, I fit into that market bucket that Kelly talked to you about. We have been working with Kelly for a long time. I've been the main portfolio manager, I think, Kelly, you talked to, because I manage the balance strategy, which is our most versatile way for clients like you guys to have your money invested, because it's a mixture of equities and bonds. But I also manage our growth strategy, and Advisors Capital has several other choices depending on, where Kelly thinks you ought to be, whether it's small and mid cap or international strategies or things like that. So what I wanted to do tonight for you guys is just to give you a sense of what the heck is going on in the markets, what's happened so far this year, and what investors really are looking for. And I think if I forget to do it, Kelly, make sure you ask me at the end, what happened today? Because today was an interesting case study of what's been going on in the market for the last couple of years. So let me share my screen. I'm going to just go through some slides. Please don't take these numbers too seriously. There will be no quiz at the end of tonight's discussion. I won't put on my professor hat and require y'all to be able to come back to me with all these numbers. So, okay, so just say, as I said, where the heck are we? How did we get here? And what does the investing environment look like? A lot of you guys, I'm sure, have equity exposure, bond exposure. You might be wondering, hey, the market's gone up a lot. What should, should we still be invested in the equity market? Short answer to that is yes, and let's talk about it. So let's just take a quick look at where we are. And this is last few years of some of the major indices that y'all probably watch. The S&P 500, which is an index that is weighted 500 different companies. They're weighted in importance index by their market capitalization. So bigger companies factor into that index in a more important way, like Apple and Amazon, Microsoft, and NVIDIA. The equal weighted index is basically telling you what's the average stock of those 500 done this year. So the average stock, as you can see, is only up roughly 4%, 3.9%. But the S&P 500 index is up almost 17%. In fact, after today, it's a little bit less. Year to date, though, what we see happening is the S&P 500, the market, as most people refer to it, it really has been driven by a handful of stocks. And if you haven't been paying attention to the market, good for you. You're doing what you're supposed to do. You're living your lives, and you're letting Kelly, help you with your financial planning and everything else, and letting me hopefully help with the investing side of things. But just to give you a sense, once in a while, it's good to check in. The market is up a lot, and it's up a lot primarily because of a handful of companies that have been dubbed the Magnificent Seven, which is actually a terrible acronym, because if you've ever seen the movie, only 3 people survive of the Magnificent Seven, and we expect far more than 3 of these to continue to do well over time. And the Magnificent Seven included companies like Apple and Microsoft and Amazon. I'll give you the full list in a second. But of that 17.7% increase in the S&P 500 year to date, these were numbers as of a couple of days ago, about 2/3 of that 17.7% came from 7 stocks. And the average return on those 7 stocks was about 50%, that 49.3%. So you can see why maybe a handful of very big companies have been driving the market, because the S&P 500, again, is dominated by big companies how the index is constructed. The average company, as you saw in the previous slide, up 3.9%. If I add dividends to that, makes it about 4.5%. So if you've been getting about 4.5% from your portfolio, you're doing average, which is not so bad. The reason why you don't necessarily want to lament, hey, I wish I had owned the Magnificent Seven, because that leaves you awfully undiversified. And if those companies pull back, by the way, like they did today, you will see disproportionate declines in your portfolio. So we at Advisors Capital strive to make sure you're diversified, but also we do actually give you a bit more exposure to growth than the average stock has gotten so far this year. So this is an example. This is a chart. I hope you can see the lines. The blue line, the one that's the highest there with that 49.3, 49.28, is the Magnificent Seven's return year to date. And you can see how much bigger that is than the S&P 500, which is the white line. And then the orange line is the average stock in the S&P 500. So you can see basically it's those 7 stocks that have pulled up the S&P 500 index. And then if we look at different kinds of stocks, we get also another different picture. So once again, the yellow, or the yellow in this case, is the S&P 500. That's up about 17%. The purple line is a large cap dividend index. ETF is DLN, purple line. Notice that the large cap dividend companies in the S&P 500, by the way, they are not up nearly as much as the market as a whole. Why? Because those Magnificent Seven stocks don't pay a whole lot of dividends. In fact, some of them don't pay any dividend at all. So if you want dividends out of your portfolio because, well, they help you sleep at night, you're going to get those dividends every quarter, So even if the stock price goes down, you know you're still getting the dividends. You're getting just as many dividends before, regardless of what the stock price does. So a lot of people, we find, like to have that in their portfolio. So you give up a little bit of appreciation when you get that kind of safety, but it's an awfully good way to set up your retirement so that you know, hey, I've got these expenses. I'm going to have these dividend stocks that are going to cover my expenses, and that's a good way to arrange things. So the dividend stocks haven't done as well, and the reason for it is that they're not the high flying Magnificent Seven. We'll talk a little bit more about why they're high flying in a little bit. And then those other couple are the blue one, the lowest line there is even higher dividend paying stocks. So those have not done as well. Why? If a company is paying a lot of dividends, think of it this way. They're not taking the sales revenues and they're not reinvesting them in the business, in new product development, for example. They're paying them as dividends. They're set up that way. They're mature companies, or they're the sort of companies that are just generating lots and lots of cash and paying them to their shareholders. So really high dividend companies tend not to be high growing companies, not the kind of companies they are. And so when you just compare the indices, you tend to see that. So depends what you want out of your investments. You want the income, helps you sleep at night, pays your expenses. You're going to give up a little appreciation, but that's okay because it tends to make your life better. There are the Magnificent Seven for you. As I mentioned, Microsoft, Apple, NVIDIA. If you look at the column all the way to the right, you can see how much those stocks have gone up year to date. NVIDIA, the shining star. It's had, out of the last 4 years, including this year, it's had a tremendous run. Google, Amazon, Meta, and Tesla, not so much. It was originally in the Mag 7 because in 2023, look what it did. It was up a boatload. And that's when the Magnificent Seven got its name, so to speak. So the reason for this big change, in case you have been living an exceptionally good life and not paying any attention whatsoever to the market, is that artificial intelligence has become a thing. It's been around since 1950, artificial intelligence, but it's never been able to be put to good use until quite recently. And artificial intelligence, or generative artificial intelligence in this case, is a way to do more with the data that's out there in the world, whether it's textual data, whether it's unstructured data like pictures and video and other things. And if you played around with ChatGPT, for example, the chat bot that you can write questions to it, it'll write back to you as if it's a real person. You can see how, how much potential there could be. I'm not going to go into a lot of details about AI. We simply don't have the time, although it's a fun subject. But the reason why we saw a takeoff in a lot of these stocks was because of the potential of developing applications from artificial intelligence that could make businesses more efficient, that could make call centers more efficient. For example, that's probably one of the ones everybody can imagine is instead of talking to a human, you actually talk to a chatbot that's useful, as opposed to those recorded answers to things which were never useful. You can imagine ways that video games will be improved by artificial intelligence. You can imagine ways that drug discovery will be improved through the use of artificial intelligence. You can imagine ways that software developers can use artificial intelligence to help them write code. So there's a lot of productivity benefits that we do expect are going to come down the pipeline. And this has all been enabled by computational power. You had to crunch a lot of data, and that is a vast understatement. And it was only recently that we had the chips, the semiconductors that were needed to do that. And those chips came from NVIDIA. It was their step change in capability in these processors that made this kind of computation possible. And they have been selling as many of these chips as they and their partner in manufacturing, Taiwan Semiconductor, can make. And so that's why you've seen this massive change in NVIDIA's stock over the last few years. And Microsoft and Amazon are two of the main providers of the capabilities to do AI. They provide the servers, they provide the data centers where you can go and basically run models and do applications of AI. Apple recently announced that they would be embedding AI capabilities in their next generation iPhone. And that stock had been lagging all year long until that became clear to people that they would be using AI in the next generation iPhones coming out later this year, the iPhone 16. Amazon, of course, is one of the big servers, but they also use it on the retail side. And then Google, of course, enhancing search with AI. And then Meta using it for their internal uses, not so much selling the capability to use AI. But anyway, the point is there's a lot going on. Tesla is not really in the game, although potentially self-driving taxis might be something where they use AI. But the point is there's been a step change in the perception that we might have this new thing, potentially revolutionary technology, and the picks and shovels providers like NVIDIA, Taiwan Semiconductor, AMD, Microsoft, Amazon are so far the winners. And that's because that's where all the spending is happening. And that's really what's been driving up the S&P 500 this year.
But before you move on, would you go back to that slide? I want to make a point here that I think you'll agree with. You tell me if you agree. So if you guys will notice, 2021 was an up year for all of these particular stocks. It was up year in general. 2022, look at that, way down for all of these stocks, and the market in general was down in 2022. If you panicked in 2022 because you didn't have a plan or you didn't have a good wealth manager on your side like Joanne or me, look what you would have missed in 2023, and look what you would have missed year to date in 2024. My point being, when you have a strategy and you have a portfolio manager that's managing something for you, staying invested, I think, is very key through any kind of markets we're seeing if the underlying investments that you're in are really good. Now, this is just these 7 stocks, but I wanted to make this point here because if we panicked in 2022, look what we would have missed out on, even in these stocks. But overall here, go ahead, Joanne.
Yeah, no, that's an outstanding point, Kelly. And I wanted to contrast those stocks that you just pointed out, the Mag 7s, and how much they went down 65%, 50%, 30% to the S&P 500 as a whole. They did have a lot to do with the S&P dropping 19%. If you contrast that with the NASDAQ, which is largely growth stocks, that was down 33%. So our growth strategy was down about 30% in 2022 because it was full of growth stocks. They all got crushed. We can talk about why, but a lot of it had to do with interest rates going up. But as Kelly pointed out, look at how much they recovered. Look how much the NASDAQ recovered. All those growth stocks right back up again. The market as a whole up again. So you're right. If you panicked, you lose out. You have to have a plan. You have to stay invested for the long term, whether you're in a growth strategy, whether you're in a balanced strategy, or anything else. There may be a time, values doing its moderate thing here. But there have been times, there have been periods in history when value has vastly outperformed growth. So it's really hard. You have to stick with your financial plan as Kelly and you guys work out together. And then you let the investments do their thing to make sure you're meeting your goals. But the long-term investing is really critical to that. And that's why at Advisors Capital, one of the products I think that you guys have found so useful is this balance strategy, particularly T3 balance or T4, T5, where we target yield. We're targeting a yield of 3% on the equity side, plus more than that on the fixed income side, or 4% on the equity side for T4, 5% on the equity side for T5. And that way, if the market does go down like you have a year like 2022, you minimize the number of stocks you actually have to sell to generate the cash you need to meet your financial needs. And so that's why those strategies have been so popular, because it helps people ride out those declines in the market. Okay, so moving on from those guys, just year to date, just pointing out something weird. So communication services, that one that's circled, that's where Google sits, by the way. And Disney is also there, and Infotech. Those are the big winners so far this year. But this one down here, utilities, you don't often see utilities going up by 8-9%. And the reason why they've done so well this year, it's sort of a fun thing to know about, is because AI. You think AI, utilities, what the heck does one have to do with the other? Well, it turns out to run those big, powerful chips from NVIDIA inside servers and data centers, it takes a lot of electricity. And so the utilities are seeing a growth trajectory. You need more of them. And so the utility stocks are up on this, which is sort of interesting. Okay, but interest rates have been coming down this year, which is good. And that's something that eventually is going to help the rest of the market, as actually it did today. Okay, so one of the things we look at as investors for you guys is we try to find stocks that are not so expensive. And one of the things we look at to measure how expensive a stock is, how expensive it is to buy a company's shares, is the forward price to earnings ratio. That's the forward PE at the top of the slide. And this is a history of the P by forward P. It's the price of the stock divided by relative to the earnings for the next 12 months that the company can deliver. So if I'm going to pay $100 for a stock and the company is going to generate $10 in earnings, that's a price to earnings ratio of 100 to $10. So 10, right? That's pretty good price. Right now, the market is trading at about 21 times. So you're paying $21 for every dollar of earnings that a company is going to earn over the next year. That's the average for the S&P 500. So as you can see, the average for 30 years is only about 16.7. So we're above average. So on average, stocks are a little bit more expensive than they usually are. That doesn't mean it's not a good time to invest. What that means is that we have to be picky. We've got to find the companies. Now, fortunately, there are a lot of companies out there to choose from. And in fact, there's plenty of opportunity to find stocks that are trading much cheaper than the average for the market. And growthy stocks tend to be more expensive because you're not just getting next year's earnings when you buy a company. When you buy shares in a company, you can own that forever. So you're not just getting a claim to this year's earnings, you're getting a claim to next year's and the year after that and the year after that. So growthy companies tend to have more importance placed on the earnings they're going to develop over the next 10 years. Whereas, state-old consumer staples, they're not going to grow that much. So their multiples don't tend to be as high as the growthy companies. Anyway, point is, we're above average, but that doesn't mean that we're stuck owning expensive stuff. It means we have to be pickier about it. And that's where we do a lot of research, try to figure this out. That's just more numbers. Yeah, things are expensive, but the top 10 companies are really pulling up that average. The top 10, the biggest companies in the market, are trading at $30 for every $1 of earnings. And the rest of the market, it's only trading at about 17.6 times. So not so bad. Not so bad. Just shows you can go hunting for bargains out there. Okay, and basically what we're seeing is that a lot of the increase in stock prices we've seen over the last year really has been supported by earnings. And that's a great sign. And when I described AI, it's because, and NVIDIA's stock has gone up so much, it's because NVIDIA's earnings have gone up. And I don't have the number right in front of me, but it's something like NVIDIA stock has gone up 200 and some odd percent over the last 2 years, but their earnings have gone up 400 and some odd percent. So the stock price is supported by their earnings growth. And that's true for a lot of the Magnificent Seven, whether it's Microsoft or Amazon or Apple. And that's really reassuring. So if you look at the Magnificent Seven, the average return is about 33%. This was some slide from JP Morgan, so it's a little bit more dated than my numbers. And their earnings have largely been supportive of that. If you look over here to the right, these green bars show you how much earnings growth these guys generated in the first quarter of this year, are likely to generate this quarter and then out for the next couple of quarters. So there's a lot of earnings growth, and that means the companies are producing more stuff and they're generating more profits. And so they are worth more. And that's why stock prices go up. So long as we can find stocks that are going to generate those kind of, earnings that are going to support the stock price, we can pay for them. We're willing to buy those stocks. Okay, and another thing that's happened recently is one thing that we watch for when we're looking for companies to buy, right, for your portfolios is we want companies that can increase sales, but we want them to be able to increase those sales without giving up profit margins, right? If they're cutting prices to increase sales, well, that's not sustainable. And so we'd like to see profit margins either stable or expanding. And for a year after the pandemic, sort of the worst of the pandemic, profit margins actually started falling again. But recently, margins are rebounding. This is a pretty good time for companies. And the reason why they're rebounding, it's not because they're able to raise prices a lot these days, as you know, right? Price increases, companies are finding customers are pushing back. Like, no, 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 you already raised the price of that Coca-Cola, no more. I'm not buying it anymore, right? There's been a lot of resistance now to price increases, but what's been improving is the input costs. The supply chain has gotten better for companies, and their input costs are going down a little bit. You might, in fact, even start to see prices being cut. And the latest CPI numbers that came out today show that prices are actually falling in some categories. And that's a rare thing. Prices don't often get cut. They stop raising them, but it's rare for prices to actually go down. And we're starting to see that in the data, which is pretty encouraging. Okay. One of the things we also look for investing ideas is not just earnings growth, but connections from one area to another. I mentioned utilities being this sideways beneficiary of the artificial intelligence revolution. But another area comes from the spending that the AI data center providers are doing down the line. And so they are supporting new deployments of artificial intelligence across the economy. And this lower right-hand corner sort of shows you some of the places where AI is starting to be used. And what we look for are the companies that are leaders, whether it's a Honeywell or a Caterpillar. They are both using artificial intelligence to enhance the products they can sell. Now, why is that useful from our perspective as investors? Well, we know if they can sell better products, they're going to lock in their customers. They're going to retain those sales for longer, and they're going to be able to acquire new customers, increase sales, and increase profits. So we're out there looking to find out which companies are being successful in deploying these new AI applications. Caterpillar, by the way, is using AI in a lot of their farm equipment, or they're integrated, with the AI that's being provided by sensors that are all over now farms to see, for example, how much moisture is in the ground, where the fertilizer needs to go, where the fields are ready to be harvested, where the pests are becoming problematic, where pesticide needs to go. And so that connection between the sensors and then the AI then helps direct Caterpillar equipment to do the jobs farmers need to do. So the better equipment Caterpillar can design and sell, the better for their profits over time. So we're looking into all different areas, whether it's industrials, whether it's finance, banking, back offices being approved, for example, or elsewhere. So connections is one of the things we do as portfolio managers, try to find good ideas for investing. Now, lately, and this bears on today's action in the market, there's been a lot of questions about the macroeconomy in the United States, right? We know that inflation has been high. We know that it's been falling, though, recently. The Federal Reserve, the central bank of the United States, has a 2% target for the rate of inflation. That's the rate of change of prices. And we were a lot higher than that not long ago. So the question is, when is the Federal Reserve, which has raised interest rates to try to curb inflation, when are they going to get to a point where they can begin cutting interest rates again? So that's a big question. And the more the Fed sees inflation coming back towards its 2% target, the more the Fed can attend to its second mandate. So by law, the central bank has two mandates. One is price stability, which has been defined as 2% inflation. The second mandate is maximum employment. And so Jay Powell, the chairman of the Federal Reserve, spoke this week to both the Senate Banking Committee and the House Banking Committees and answered a lot of questions. And in his answers, he clarified that, well, yeah, inflation is coming down towards 2%. It's not there yet. But the labor market is now starting to show signs of loosening, and maybe, they need to start paying a bit more attention there. He didn't quite use that word. But unemployment has gone from 3.4% up to 4.1% over the last several months. And again, the dual mandate is maximum employment. So you don't like to see unemployment going up. That's still very low, by the way. But he said a lot of things about the labor market, which gave people a sense that the Fed may finally be getting close to cutting interest rates. And interest rates, as high as they are, raise the cost of doing business. They cut into profits. So lower interest rates would be good in a lot of ways for companies and for the equity markets. And so that's why it's prominent here in this discussions among investors. We'll talk a little bit more about it. The impact of higher interest rates for longer, that's what this is, higher for longer interest rates on equities, is that higher cost of doing business if interest rates are higher, but also higher interest rates means you're discounting the future more. And that's bad for the value of companies. So higher rates tend to lower equity prices. And the other big question, getting away from inflation and the Fed, is will the consumer continue to spend? We know some consumers are really constrained by the last few years of inflation. It's cut into their budgets. They're living hand to mouth. We know that the low end consumer is really struggling. And now even the mid-range consumer, they're starting to have to, make economies. Costco is a beneficiary, by the way. Target is a beneficiary. TJ Maxx is a beneficiary because people, when they want to save money, go to those places. So we need to know, will the consumer continue to spend, or we need to at least have a sense of how much risk there is. The U.S. government has been running a deficit for the last many years, right? Increasing the debt. Question is, how much of a risk is that for equity investors? And then, of course, we've got the not just elections in the U.S., but we've had elections in Europe and in Asia, and we need to understand, or at least position for, some of the risks that might bring. And then, of course, there are those pesky little wars that are going on around the world, and potentially new wars in Asia. So these are all things that we as portfolio managers think about and contemplate when we're trying to set a portfolio up to be diversified, so that when a bunch of areas weaken, not everything in the portfolio weakens at the same time. As Kelly pointed out before, in 2022, those Magnificent Seven stocks got crushed way more than the market as a whole went down. So if we have all your eggs in those kinds of baskets, you'd be in real trouble. So we need to find ways to diversify some of the risks that are listed on this slide. So let's just think a little bit more about that first one, which is interest rates and the CPI. This is the Consumer Price Index. This is one of the most commonly cited inflation measures out there. The Fed looks at a different one. This is a little bit more reliable, but it's been coming down. So in May, it was 3.3%, and the June figure was just released this morning, again, showing an inflation rate of 3.3%. So, it's actually, sorry, 3.0%. It came down a little bit. So, things are improving. And as you can see, we're well off our peak back in 2022. So we had a severe shortage of goods because of COVID, right? If you remember, everything came to a halt all around the world. No goods, but consumers still have plenty of money in their pockets, right? Because governments, first the Trump administration and the Biden administration, basically said, hey, we're going to transfer you guys some money because we don't want y'all to starve, right? And so people had a lot of cash, but there wasn't a lot to spend on. You couldn't go out to services. A lot of things were shut down, and supply chains were really snarled because you couldn't manufacture stuff because factories kept closing because of COVID outbreaks. So there wasn't a lot of supply, but there was a lot of demand. And so that's what happens. Prices go up. You had this big spike in inflation. And so we're just slowly getting back up from that with reducing demand by the Fed raising interest rates. It tends to curtail spending. And also the supply chain has been improving, and that's been helping to bring inflation down as well. So both of those things have been working, thank goodness. We're getting back to stable prices, which an economy likes a lot better than rapidly rising prices. So things are getting better. The Fed has been doing its job, which is great, and supply chains have been improving all on their own, which is great. But the Fed isn't quite there yet. Their goal is 2%. So we don't know when the Fed is going to say, okay, we can reduce interest rates. We do know that there's still a fair bit of inflation embedded in the system, primarily on the services side, whether it's dining and recreation, whether it's food or shelter. Shelter is the biggest one. That's the biggest source of inflation. Those are rents. Everybody knows if you've been looking for an apartment, or if your kids have, it's expensive out there. And it's gone up a fair bit in the last couple of years. And so that's still a pretty big contributor to inflation. So, but apparently it's improving. So that's a good sign. The economy as a whole, though, is in pretty good shape. I know there's a lot of numbers. I'm trying to dazzle you with numbers here, overwhelm you. Look at the top line, right? This is GDP growth. This is real production in the United States, okay, adjusted for inflation. You add inflation to this, these are much bigger numbers. So this is like strip out inflation. That's pretty good, growing at 2.5 last year, 2.3% this year, 1.8, 2 point. That's like where we pretty much should be as a big, diversified, massive economy. A couple percent of real growth is about where the US should be. That's pretty good. That's not a recession. That's just like normal long run growth. And those interest rates, though, those pesky interest rates, they have yet to come down. The Federal Reserve controls the very short-term interest rate. It's called the federal funds rate, right? It's their policy rate. That's the one that they've been raising. And as you can see, right, that rate went way, way up, peaked out between 5.25%, 5.5%. We're waiting for them to cut the rate. Everybody says, when's the Fed going to cut the rate? Well, they have meetings every so often. One of them is coming up in July. Then there's one in September, November, and December. There's 4 more meetings this year. The smart money, as they say, is on December at this point, that they'll cut in December. Fortunately, our Federal Reserve is an independent central bank. It's not part of the US government. And they have a hard enough job figuring out what to do with policy. They have reiterated many times and pretty much proved in history that they don't pay much attention to elections and things like that. There was one exception to this at some point way back in history, but we haven't seen really much evidence of it since. So, the reason why they're not cutting rates is simply because inflation hasn't come back down to their target yet. And while it's coming down, 3.3% isn't 2%. And so we don't think the Fed's going to be in a hurry to cut rates unless something really bad happens with unemployment. Yes, it's gone from 3.4 to 4.1, but that's still pretty low for a big, complicated economy like the US. So we don't think the Fed's going to be in any hurry. But on the other hand, we are seeing weakening of the consumer, particularly at the low end. They're feeling the hurts of the past inflation. It's definitely crimping their spending ability, their budgets. So if things weaken further and if firms start to decide, you know what, man, the consumer's spending a bit less, maybe I'll fire some people. Maybe I don't need as many people as I did before. We saw already some firing in the tech world last year. So, it's always hard to predict because it's such a complicated economy and, there's no coordination. It's just what does a CEO think is best for the company today? And if he thinks it's best to cut by 10% of the workforce, that's what will happen. And, next door, maybe the CEO at the next place, and she might be thinking that, hey, this is a good time to hire. So in a complex economy like the US, it's really hard to get a sense of this in advance. And recessions are almost always unpredicted. And we should probably expect the next one to be unpredicted also. For now, as I said, we're in pretty good shape. And even if a recession does come along, we've had lots of them in the past. And if you look at a long history of the S&P 500, it goes up. Yes, there are little setbacks along the way, but if you stay invested for the long term, that's a winning strategy. So we do expect rates to come down eventually because inflation is moving the right way. We don't know when the Fed's going to cut, but you know what? Our investing strategy doesn't depend on the Fed cutting rates because we're diversified. And we still have some assurance that even though growth has slowed in personal income, the real purchasing power of income, the amount of money people are making in this country is still growing. It's still above, the growth rate is still above 0. So real personal income, disposable income after taxes is still growing. That's a good sign. And it turns out that spending, consumer spending is still growing. It's still above that 0 line. That's growth. Even though it's growing slower, it's still growing. That's a good sign. And more people are getting jobs. And that's why spending and personal income, by the way, is still growing. Because maybe an individual household is struggling, but more households are employed. More people in households are employed. And therefore, aggregate spending is still doing pretty well, even though segments of the population are struggling. So you have to pick your companies according to the economic environment. Wage growth is still about 4%. That's pretty good, staying ahead of inflation. And unemployment still pretty low. Now, here's a cause for concern. There are more delinquencies showing up in credit cards and in auto payments. That tells us something, again, about the lower end of the income distribution. These are the folks who are really struggling. They're starting to default on their credit cards. They're starting to default on their auto loans. That's a warning sign. That's in this lower graph right here. But the interest rate burden of all the household debt, credit cards, etc., isn't any higher than it was before the pandemic. So in aggregate, again, it's not such a problem, but this is telling us that there are some households that are really struggling. Okay, worried about the government. That's a problem for a later date at this point. And then finally, I just wanted to say that the appreciation we've seen has a lot of support in earnings growth. This is a chart that looks at earnings growth for different sectors of the S&P 500, of the companies in the S&P. And in the middle, it's S&P 500. These are just two different, the bars are basically just at two different points of time. What did analysts think the companies in the S&P 500 were going to generate in terms of earnings in 2024? 11% earnings growth expected for this year on average for the S&P 500 companies, for those 500 companies. The biggest growth is likely to come out of communication services and information technology. That makes sense. That's where you've got your Apple and your Microsoft and your Nvidia and your Google, right? Banks, turns out, having a good year. Consumer discretionary, that's where your Amazon and Tesla are sitting. Not so good, well, energy. Energy prices are down this year. They're not making as much money relative to last year, but still not bad, a little bit lower. But last year was a stellar year for energy, right? Materials, again, not a great year. A little bit of a slowdown because of those higher interest rates. A lot of projects got pushed off. Higher interest rates make the cost of doing projects a little higher, so things got delayed. And staples, we never expect much from staples anyway. 4% growth, 3.8, that's pretty good for a consumer staple company like, say, Unilever or General Mills. Next year, though, what about next year? Because doesn't this year's stock market depend on next year's expected earnings growth? If there's no earnings growth next year, well, this stock market rally is probably going to fizzle. Well, it turns out we're expecting to see a fair bit of earnings growth next year, too. We're looking at, for the average, 11.6%. Led by utilities. Yeah, remember what I was saying about AI? Turns out there's a lot of expansion going on in utilities. Now, that's off a pretty low base, so don't get too excited by 32% growth in earnings in utilities. It's also a tiny, tiny part of the market. Not a lot of utility companies out there with a lot of market cap. Real estate, similarly, a small part of the market. When you get to the big parts of the market, infotech, 13.7% earnings growth. That's a lot of growth. So if there's change in information, though, if there's disappointment, if these numbers get revised, the market could adjust. But just be aware, the market's forward-looking. We care about what these companies are going to deliver for us in the future. That's why we want to own them. And so we care about what kind of earnings growth we can expect. So this is a pretty good outlook. It's a good time to be investing in equities. As I said, some stocks are expensive, but we can hunt around. Now, in our balanced strategy, I know a lot of you folks are probably in this strategy. This is some data on our current or roughly recent top 10 holdings on the equity side. Obviously, on the fixed income side, we have all sorts of bonds. The bonds in your portfolio, by the way, are going to be different depending on when you arrived, when your money was invested through Kelly and through us. Because when we find bonds to put in your portfolio, every account is a unique situation. What we do is we say, okay, we're going to get this many investment grade of this kind of sector and that kind of sector, and we diversify just like we do on the equity side. So I can't even list the top 10 bonds because there are hundreds and hundreds and hundreds of bonds when we look at all of our different clients in this strategy. Even just all of you guys, there'd be hundreds of bonds. But we can at least talk about the top 10 on the equity side. And again, you're seeing some of these bigger companies, partly because really like these companies. They provide essential products. Apple, Broadcom is this company we've owned forever, ever since I joined the firm. Diversified, critical component maker for the iPhone, critical component maker for data centers, for communication networks, cybersecurity software. Microsoft, obviously, critical company. What we look for are companies that are going to be crucial to the US and global economy going forward. These are some of those. AbbVie in healthcare. I'll give you just an example of how we think about this. AbbVie, they're both a standard pharmaceutical company, prescription drugs, but they also do aesthetics, Botox, which is, it's not a necessity. It's a like to have. And so it's not subject to regulation. You don't have to worry about whether the government's going to come along and put limits on Botox pricing, right? Because it's a luxury product in a sense, and that gives AbbVie quite a bit less risk exposure than perhaps some pharmaceutical companies, which are entirely vulnerable to government regulation, and they pay a really nice dividend. So I think it's like 4 or 5% at this point. So in T3 Balanced, what we try to do is combine growthy companies like an Apple and an Amazon that pay 0 or very low dividend with less growthy companies that pay a high dividend like an AbbVie. Off this list are companies like Chevron or Kinder Morgan, which is a pipeline company, carries natural gas. Blackstone, a private equity type company, and IBM. Again, these are all higher dividend companies, and our barbell approach in selecting equities for T3 Balance, again, that appreciation-oriented companies like an Apple, Microsoft, a Google, Amazon, alongside of higher dividend paying companies, like some of those listed there. And that gives us both the heading towards our 3% yield on the equity side, plus helping us deliver appreciation at the same time. Our goal is to do it with lower volatility. So some highlights for this year, our growthier holdings tend to separate our T3 Balance from our T4 and T5. If you're in T4 or T5, you'll notice that all of the companies in there have dividends, have significant dividends. And there are no companies in there that don't pay a dividend, because we got to hit that bogey of a 4% yield or a 5% yield. So a little bit less growthy, but probably a lot less volatile as well. And so, our yield goals generally mean we're not going to keep up with the S&P 500, but that's usually okay because we're not trying to, right? We want to deliver that income for you guys. And we are tending towards large cap companies because they're the most reliable. They have the best balance sheets. They have the best cash flow to support their dividends, and they have higher quality, which we really like. We recently, though, added NVIDIA to our T3 Balanced. Doesn't pay a dividend, well, pays a de minimis dividend now. But we really wanted to make sure that we owned this company because of the critical role we think they're going to continue to play, and because there's a shortage in the chips that they're trying to make and supply for this AI revolution. I was a semiconductor analyst, right, as Kelly mentioned at the beginning, so I've known NVIDIA since 2004, and Jensen and I have had disagreements about the role of graphic processors and their competition with AMD, which is the other producer of graphics processors. So I did wait a long time to get NVIDIA into this portfolio because it was so risky, because it was so expensive relative to its earnings. But we did fortunately get in before the latest takeoff of the stock, because I felt like a lot of the risk had now lifted, that they had a very solid market opportunity, that they were supply constrained, and that therefore they would have a pretty long runway of growth. Now, that's not to say that stock won't pull back. It could easily drop 20%. As Kelly pointed out in 2022, a lot of these stocks dropped 30, 40, 50, 60%, but then they rebounded. And so that's the kind of thing we try not to have too many stocks like that in T3 Balance. We want it to be fairly stable, but sometimes you find situations where you don't want to miss something that can really contribute to growth over the long run. And so we did add that recently. Okay, I would like to turn it back over to Kelly. And I would just like to leave you with one picture, which is this one, which is every year the market generally goes down. And those red dots and the percentages are the maximum decline in the S&P 500 in each of those years since 1980. And the black bars at the top are where the market finished that year. So take the first piece of data, 1980. The stock market had fallen 17% at one point during the year, finished up 26%. So pullbacks, corrections, whatever you want to call them, there's no reason to panic. They happen. Almost every year has a pullback. More than half the years on that chart, the pullback was more than 10%. And still, in more than half of those cases, the market ended up for the year. And if the market didn't end up for the year, which is a rarity, as you can see, in almost all cases, except for the 2000 aughts, where you had 3 down years in a row, very unusual, except for that sequence of years, the market was up double digits in the year following a decline. So in other words, it's worth riding out market volatility. Okay. So
Well,
that's all.
thank you, Joanne. Beautiful. Leave that up there. I like that. I have some things I want to comment on about Advisors Capital specifically. I love Advisors Capital in many ways, and as Joanne talked about here, you can see why I like them so much. They've made a lot of money for my clients over the years, which is fantastic. I love Advisors Capital because they buy individual stock positions, bond positions too, but individual stock positions for you. And Joanne, it's usually about 40 stocks per portfolio you do.
Yeah, 40 to 50, depending on the strategy. And that's just on the equity side. Obviously, the bond side, there can be a lot more depending on the size of the account.
Yeah. So I love that they buy individual stocks for portfolios. So there's, as she's mentioned here, there's a lot of thought that goes into each stock they buy, a lot of research. I think, Joanne, you've even many times gone to visit the companies that you're putting in your portfolios, seen the plants and met the CEOs and all of those
Right.
kind of things. Yeah. And that's what I do too, as many of you know, when I do portfolios for folks, I go to the real estate person, the CEO of that company. I go and meet them. I go look at the real estate. Joanne, I've been out meeting all of the doctors of the economy that run Advisors Capital as well, to get to know them and their strategies of what they do and why they do it. So I love that they buy those 40, 50 or so individual positions for you in each portfolio that we design, based, of course, on your risk tolerance and what your goals are. It's not a group of mutual funds. And I have a big pet peeve against a lot of the big wirehouses, for instance. They buy 10 or 20 or 50 different mutual funds for portfolios for folks. And there's a lot of stock intersection there. A lot of the different mutual funds own the same stock. So not only are you in the market, you're very concentrated on each individual mutual fund owning the same thing. I don't think that serves you, frankly. And let's tailor make this for you. So I love that about Advisors Capital, that they don't do that. They're not buying a bunch of mutual funds. And then they can also tax manage accounts for you. So if you're transferring an account from somewhere else to us, to Advisors Capital, and you have a lot of gains, embedded gains in there, we can tax manage that for you over time. So there's a lot of services that Advisors Capital provides to me and my clients that are very beneficial. Also, if you say, hey, I don't like tobacco, I don't like oil and gas, or something like that, we can certainly tailor make that for you as well. I like to let Advisors Capital go, frankly, because they're so good at what they do and they're so good at evaluating each position that you go into within the 40, 50 stocks or so. I want them to be able to decide whether or not they're going to buy or sell something. I just, actually, Joanne, you'll chuckle at this. I just met with a client yesterday. She's not on the call here, I noticed tonight, but she's in Advisors Capital. And she was looking at her list of 40 or 50 stocks, and she says, well, what about that one? I think we should sell that one. I said, well, I'm going to let Advisors Capital decide when they're going to buy or sell something for you. I'm not going to tell them. They've done way more research on that individual position than I have, and they're going to really know better when's a good time to buy or sell something. And so she went, oh yeah, okay, I understand.
Good job, Kelly. Good job.
Yeah, well, I let you guys know more than I do, so I'll admit that.
Yeah, I'm glad you pointed out those other things we do for clients. In fact, I'm reviewing as always. But right now we've had such a good run. Broadcom, for example, is up a bunch. I just noticed it's above my target weight for a lot of clients. And so what we'll do is we'll go through and we'll trim those positions.
Yeah.
And because these are positions that which I've appreciated, now I've created realized taxable gains
Right.
for clients. And so, you know, when we have a year like this, when we're trimming things because they're going up so much, we will actually go in and sell something that's down almost immediately to tax loss harvest.
Yeah.
So that we can sort of stay on top of these taxable gains we're creating and offset them when we have the opportunity. Because who knows, these stocks that are down today might rally at the end of the year and might lose the chance.
Yeah.
So you'll see some trades happening now in the near term as we try to take some overweight positions back down to where they need to be, and then we'll try to do some tax loss harvesting. So if you do see a stock that's down being sold, don't assume it's gone forever. It could just be something we like, but we want to capture those losses and then add it back in.
Yeah, and I've had a few clients recently, as I talked about, doing a whole financial portfolio for someone. They've been with me for a number of years. We've been in Advisor Capital. They've been in the growth part of your Advisors Capital strategies. And now they're getting closer to retirement and they need to create income off of those portfolios. So now we've gone back to you, Joanne, and all your team and said, okay, this is where the client is. We need to start creating income off of this. And there's been gains. So I don't want to just sell everything and then go into income oriented stuff. So again, we're looking at the tax management of that. So the client's not hit with a huge tax gain this year. We're actually going to spread it out a little bit for them so we can get the strategy they want based on the strategy they used to have. So I love the personalized service. And as many of you know, that's what I pride myself on at California Wealth Advisors. Me and my team, we pride ourselves on tailor making portfolios for you specifically, which of course you don't get at big wirehouses. Not that there's no place for them, but that they do their own thing. But I'm a full service advisory firm, so I'm going to bring you a lot of different things that they can't. Advisors Capital certainly being one of them. So I have a question here. Well, before I end, we have one question. David has a question. What happened today in the NASDAQ?
Oh yeah. Right. So today, so first of all, earlier in the week, Powell came out and he sort of emphasized more the labor market. Okay, maybe we need to start. The implication was, okay, we might be getting closer to a rate cut because inflation's coming down and hey, unemployment's up and the labor market's getting looser and okay. And then this morning, the CPI data came out. And the CPI data was a little bit lower than expected. In particular, there was a drop in the headline CPI. It actually went down month over month by 0.1%. And so the headline CPI had been 3.3% year over year. Now it's 3.0%. And that's it. And that's the Fed's trying to cut inflation. Okay, we just got a data point that said, hey, inflation's slowing down. Even though it's the headline, it's probably driven by lower gas prices. But nevertheless, the market's sort of shallow and they looked at it and they said, okay, hey, inflation's coming down. Maybe the Fed will cut rates. So the expectation came that the Fed may cut rates sooner than expected this year. And so, hey, that'd be good for equities. And so it was an asymmetric response in the market. The stocks that had been sort of almost the safe haven, it's bizarre. The safe haven stocks were Amazon, Microsoft, Nvidia, Apple, those magnificent seven, the AI companies had been the safe haven. Let's just go own them. All of a sudden, interest rates are coming down. Oh, we can own everything now. Equities are going to rally if interest rates get cut. And so people took money off the table from those winners like Nvidia. And they said, okay, let me go invest over here. And in particular, small cap did particularly well because small companies are hurt by higher interest rates. Higher cost of doing business really has hurt them. And they've been undervalued now for 2 years. So a lot of money went into small cap. It was up, the index was up 3.57% today. The NASDAQ, again, which is heavily weighted by those big winner companies where basically people were pulling money out of those to spread it around the market today and reposition. So that's what happened today. It was a positive statement about equities overall, even though the indexes look like equities went down today.
Interesting. Yeah. Wow. Amazing.
Yeah.
Joanne, why don't you give me back the slides?
All yours.
There we go. Okay, great. I'm going to share my slides here. Okay, so Again, thank you, Joanne. So appreciate your time and efforts on our behalf, educating everybody here tonight. I just can't thank you enough. You're such a dear friend to do this for us. And I look forward to seeing you on the TV screen again. I always love seeing you up there when I've got the news on. It's like, oh, there's Joanne. So that now all of you out there, you'll notice Joanne when she does the TV spots that she has up there. So as you all know, I love doing seminars. I have a number coming up here, and don't forget about our client appreciation event. That's coming up on July 27th. You do have to be a client to attend that. We have lots of fun prizes and event special moments for that. Those of you that came to my Christmas party, I came as Mrs. Claus, and I was all dressed up. It was very cute. So we have lots of fun surprises coming for the July 27th. Yeah, that'll be here in my office in Santa Barbara. And it'll be a lot of fun. So those of you that don't know me, give us a call and get yourself on our calendar. I like to meet either in my Anaheim office or my Santa Barbara office. I like it to be in person because, again, I'm going to tailor make this for you when we create a portfolio for you. So with that, thank you very much. Joanne, again, thank you. Love you. So appreciate that. Everybody on the call today, if you had a question that didn't get answered, by all means, give us a call tomorrow in the office and we'll get that answered for you. So with that, thank you,
Great to see you
everyone.
guys.
Thank you, Joanne. Appreciate it.
Yep.